Once you are debt free, you need to put your money somewhere safe where it grows tax free, flexible, and you can use it as a very high paying, interest paying bank account. And that's what we call the your own personal bank. Where else can you put your money safely? Well, under the mattress, but it doesn't work with inflation. Remember, all the money in your checking account in your bank is earning no interest. Even the savings account, it might be earning 0.2%, but this money is taxable. If you put it in a money market account, you might get 2%, but that's also taxable. You'd be paying tax on all the dividends and interest you earn. Short-term treasury bills are also taxable. But what we call the personal bank, and what this is a high cash value whole life insurance, which we will explain. And it gets 4 to 5% tax deferred, and you take the money out tax free. Is the best place to put your money safely. And the inflation rate is on an average 2.8%, and this beats the inflation rate. Understand how banks really work. They will lend you money somewhere between 4 to 8%. All they need to lend you $100,000 is just $10,000 in the bank. And really, they're getting really 1,000% return on their money. Their number one tier asset is whole life insurance policies that they have on their executives, and they believe in whole life insurance. You do not get any interest on the money in your checking accounts, which we talked about, or rarely little bit in your savings accounts. If you need to borrow money during hard times, they probably will not give you a loan. The answer is create your own bank, where you borrow from your own bank. By the way, what does Walt Disney, J.C. Penney's, and Ray Kroc of McDonald's have in common? Well, they each use their cash value and their whole life policy to Walt Disney to start Disneyland, J.C. Penney's to make it through the Depression, and Ray Kroc to buy McDonald's from the two McDonald brothers. But they basically use their whole life policies. So who has a whole life policy? There is this concept, it's called the infinite banking concept. It was created by Nelson Nash, and it's been around for years, but he put it in his book, Becoming Your Own Banker. Other books have been written about it, Bank on Yourself, The Banker's Secret to Permanent Family Wealth. There's a lot of books out there, and I was introduced to this idea a few years ago, and initially it just sounded too good to be true, but as I investigated, I found that this is really the most ideal place to put your money once you're debt free. The advantages of a personal bank is guaranteed predictable growth and retirement income. You have safety with no volatility. It's flexible, which means you don't have to put money in it all the time. You could put it and just fund it for 2 years, and then you'll have a death benefit for life. You have peace of mind. There is no market risk. You have a guaranteed return of 4%. Your tax benefits and 4 to 5% growth, which is basically tax deferred, but you can access the money that's in your in this policy tax free. You are in control with easy access to cash. You never need to borrow from the bank again. No investment fees that continue to compound against you like what you would have in the stock market. Tax-free income for retirement, protection and security for your family, and an income tax-free legacy upon your death for your family. But there's certain requirements to have the right personal bank. You need to work with the right insurance agent who understands the infinite banking concepts. I would say probably less than 5% do. These agents should work for the top four mutually owned, and it has to be a mutually owned insurance company to make it work, that pay dividends to the policy owners. Examples are like Mass Mutual and Guardian. These have been around for 160 years. The policy needs to be designed so no more than 10% is used to pay for death premium or the death benefit, and 90% is directed toward cash value. And you might need a small term rider to meet the IRS's MEC rule. But this is a lot of these policies, whole life policies, are not designed this way, and I will show you the comparison. The whole life insurance policy maximizes your cash value and satisfies the IRS's non-MEC requirements. The policy primary use is just to hold and build up cash. It's like a big savings account with a guaranteed tax-deferred return of 4 to 5%, and in an environment to be used for future investments or and basically just the death benefit is secondary, but it is an important concept of this whole idea. IBC Global, Steve Parisi, is the place where I actually learned more about this policy, and we'll talk more about how to find out. And so you want to do your research on this product. In a whole life policy versus universal life, the premium stays the same. And when you have a premium that is only 10% of the policy, the cash value will actually cover it for your lifetime. But the cash continues to grow exponentially, and as the cash goes up, your death benefit also goes up. The big difference is in really policy design. For example, this is what most people buy when they buy whole life policy. The first amount of money that is spent, if they put out $20,000 a year, almost all of it goes in paying like 100% for the death benefit. And that is where most of the brokers and insurance brokers get almost 100% return on their on your money. But it takes about 3 years before any cash value is put together. And then with Nelson Nash came up, most of the policies that they design, like Bank on Yourself, Private Family Bank, 40% goes to death benefit, but 60% goes to cash value. You see immediately, instead of zero in cash value, you have 11,000 of the 20,000 and going into cash value. And as you can see here, it takes about 8 years to catch up with the money that you have invested in there to break even. But don't forget, you still have this significant death benefit for your family. And if something happens to you anywhere along the line, they get the income tax free death benefit for them. In the first example, it took 11 years. Now, what we're talking about is a policy that is designed where the basic, the lowest the insurance company will go is 10% for death benefit, but 90% toward cash value. In this example, you see, right the first year, as you put 20,000 toward the policy, 17,000 is there for you to take out, gross tax deferred. You could take it out and access it tax free. You can borrow from the policy and then pay it back. We'll talk a little bit more about that. And actually, between the fourth and fifth year, you've gotten all the money you have basically put in is all in cash value. And from then on, it just grows and grows. And when these policies are designed with the 1090, after 20 years, for example, you can see that the 1090 split has the greatest amount of cash value, 661 compared to 662 or 578, and the death benefit is much higher, almost $300,000 more in these policies. That's why it needs to be designed right, and you need the right type of agent that understands this. So basically, like we said, 87% 10% goes to death benefit in the policy, and the term is like 3% policy to up the death benefit so you can put more money into cash value. Now, when you're using a policy loan, that's how you take money out tax-free to pay off debt. Let's say here someone has put in over 250,000 over a 5-year period, but they're going to take out 200,000, let's say, to buy a beach house or something like that. And this is what's really cool about this whole process. You borrow from the insurance company's general fund, and during this 5-year period that you pay the $50,000 back, you have paid 28,000 in interest to the insurance company. But at the same time, the money that is in your cash value continues to grow as if you had not taken it out or borrowed on it. Now, and so at the end of, let's say, the 5-year period, you have the same amount of 325,000, and once the loan is paid back, you have 325,000. What this boils down to is you paid 28,000 in interest, but during the same time frame, because this is a value that continues to go up, you really made 62,000 in interest. And overall, you borrowed 200,000, paid it back, and you made 33,000. I mean, that is why this idea of having your own bank, and I can guarantee you do this with another bank, the bank is not going to give you 33,000 to borrow 200. And that's the advantage of this whole personal bank. Other advantages, one of the safest investments has not failed in over 160 years, some of these companies. It is guaranteed 4+% deferred tax return. You never have to worry about what the stock market is doing. You know it's always going to go up. When you die, the death benefit goes 100% income tax free to your heirs. And of course, you might have to pay taxes and state tax. You have access to the cash value in the policy without penalties or restrictions. Instead of paying interest to the bank, you're paying really interest to yourself now. You pay no income or capital gains taxes on the policy loans or most withdrawals. You have a guaranteed insurability for life. That's why it's important to start younger, and you're locked in for life. They can't take this away from you. In a term policy, for example, after a 20-year term, you have to go ahead and get another medical. And if you're not healthy or you've had some issue, they're not going to give you life insurance. You have unrestricted liquidity, control the money for any reason. There's great flexibility in the policy. You can start off and put, pay for 5 years. You can, pay a premium for 1 year, not pay again for another year or two. No one's going to hound you on the money. Any money you borrow from the policy, they're not going to hound you for that. In retirement, a lot of times what you do, you just borrow from the policy and never pay it back. And then it just comes off the death benefit. Other ideas, it helps you pay off debt, invest like we just talked about. The interest and dividends are paid on all the money in the cash value, even the borrowed money. You can replace long-term care. A lot of times they will help someone that it requires long-term care with the money in the policy. There are no restrictions as you find in qualified retirement plans. And you get the money, access the money tax-free, not like the 401k or an IRA. In many states, these assets are protected from creditors also, or lawsuits. And your income's growth is tax deferred, your withdrawals are tax-free, inheritance income is tax-free. Now, remember how people say the problem with buying term insurance and investing the difference is because no one ever invests the difference. But here's the real problem. Yes, a term is cheaper. Here's a 20-year term, you're paying $980 per year, while here you're paying almost $8,000 per year. But after 20 years, you paid almost $20,000 here, but $159,000 here. And you have access after 20 years, your cash value is $179,000. You have no access to cash in your terms policy. Now, at age 65, if this person was 55 years old or 45 when they started, You have a death benefit and of 537,000, and here you have a death benefit of 500,000. As soon as you turn 66, that 20-year term is over. You have no insurance at all. And actually, less than 2% ever use their term insurance policy because it becomes too expensive the older you get. And a lot of times, once these terms are done, you don't qualify for insurance. But here, you still have this death benefit in the whole life policy that continues to grow. And so when we compare this family bank or your personal bank with an IRA, you find that tax growth is tax both the growth is tax deferred, but with the private family bank or personal bank requires no luck, no skill. There are no market risks like you have in a 401k. It's, it's, you don't have to worry about complicated and emotional investment decisions. You don't have to take out money when you're 70 and a half. But there's a tax-free death benefit, which the 401k does not have. Penalty-free access to money anytime, which with the 401k you have to be 59 and a half, and you have guaranteed growth, which you do not have in your IRA or 401k. So where do you find the money to fund this? Well, actually, making more money in your job or having another job to find the extra money. Once you have paid off your debts, you have almost 2/3 of the money you ever use once that you've paid off debts to pay for this. A lot of people could probably come up with 20 or 25,000 a year when you're debt free and your house is paid for and your cars are paid for. You could reduce their contributions to your 401k and maybe just take the matched money and the rest you put forward this permanent family bank. But don't forget, it's just like money not disappearing. You have access to this money, 90% of it. Cash out all non-tax deferred investments. If you have money in the stock market, move it into your personal bank. Moving your savings into your personal bank because it actually pays better than you do in your own bank. And don't worry about getting a tax refund. Just take the money you were going to give at the IRS that they hold and just put it toward your bank. A lot of times we recommend converting, universal life policies that you have into this type of policy because you have better um, returns and the premiums remain stable, not like a universal life. But you really need to talk to your agent to see what's the best thing to do. There is a difference between whole life policies and universal life. And universal life is variable and indexed, but both policies have cash values that grow tax deferred. You can access the cash tax free on both policies and have a guarantee. The whole life policy offers consistent premiums. This is the big deal, and a guaranteed cash value accumulations, which is not offered by universal policies. Universal policy, life policies use either index funds or variable means that you just can invest in the market. So these premiums or the cost of insurance continue to grow every year. You know, they have a surrender fee on certain returns because your money is invested in the market. You don't know which way it's going to go. So this is why I recommend basically a good, solid whole life insurance policy. Here's an example of a policy actually that I've had that there was an exchange for 178. This is on a 75 or 74-year-old and could be funded for basically 6 years. And you can see the cash that grows immediately into the policy and can be used to borrow or use for your retirement. And it really only takes 4 to 5 years to catch up. Here's an example of 40-year-old, two different policies. One is indexed and basically it's paid $40,000 for 10 years, and these are the examples. of the money that is available to you that you can borrow in cash and the benefits. And after, let's say, 25 years, you can see how much cash value grows. And you can stop after 10 years, you can stop after 5 years. Just depends on how much money you want in these things. I love this example here where this is on a basically a 3-year-old child and putting 10,000 in for 30 years. A grandparent can do this, or a parent can do this. And really, when the child, in this policy, it takes about 5 years to catch up with the money you've put in. You put in 50,000, now you have cash value of 50,000. But let's say the child is 16, wants to buy a car, and you have 184,000 in cash value. You just borrow from the policy, let the child pay it back to the policy, and the money continues to grow. So you're making money while they're borrowing money. Child turns 18, he now has $221,000 to help them through college, and child pays it back. And after he graduates, and now he's 26 years old, he may get married, or she may get married, and now has close to our 415,000 in cash value to actually pay off a home or put a down payment on a home. And then the policy continues to grow, and after 30 years, you know, and the child can actually take over these payments. And at age 65, the child has $3 million available in cash value and 5 million, almost 6 million in death benefit. It's a great gift, a legacy that you can give your children or your grandchildren, like this little boy here. But if you want to learn more about this personal bank, go to Personal Bank for You and watch some of the videos by Steve Priest. He's really knowledgeable about this whole process, and even ask them to send you an illustration that might relate to you. But I would study more about it and listen to the videos, and I don't think there's a better place that you can put your money safely where you grow, where you never worry about the market. You're able to get the money, it grows tax deferred, and you take the money out tax free. So it's a great idea. Well, okay, we'll go on to the next process, which is finding peace, happy health, and happiness.